What's up, folks? Lane with the Wealth Elevator. Going to be talking about should you be selling your rental properties and turning that lazy equity into other investments, maybe even buying some savings bonds. Who knows? In some cases, I've been talking to some investors where they're only getting about 2 to 3% return on their equity. Obviously, in that case, I think you can do better. That's your guys' decisions, of course. I'd like to go out to Seattle this time. Haven't been there in about a year. And you know how it goes with LA, or maybe even we go to Phoenix, we do some property tours out there. So let me know. Shoot me an email, Lane at thewealthelevator.com, as we gear up for the year-end annual retreat in Hawaii, which is going to be Martin Luther King weekend in January. I think it's the third weekend out of that. So if you haven't connected with us before, we'd like to meet in person, or some of you guys have wanted to come back and get reacclimated with the community. Hope you guys save the date there. Again, that is going to be January 16th through the 18th, 2026. All right. So here's a little bit of the backstory. So I've been talking to a few investors lately. They've owned rental properties for quite a while now. I've referred to this as the discussion about return on equity to identify what your lazy assets are. I've got a website about this topic with the formula on there. If you want to check it out, you can go to thewealthelevator.com/ROE. But let me just walk you through the use case here. So most of the investors out there who've owned rental properties, they've bought at a good time. Back then, the model was a little bit different. They use strong leverage, just like any other private equity firm who does the leverage buyout, which, by the way, in private equity, there's 2 or 3 things that they basically do, and the leverage buyout thing is pretty much one of the big levers that they do. And it's essentially a play on real estate, not to oversimplify things, but that's pretty much what makes real estate go. Of course, that's an oversimplification of it. Now, say an investor rides the 2010s and into the 2020s, a few things then change, right? Most of the loans are now paid down. The interest rates are higher now, and the equity, it's sitting there dead money. Right? In the beginning, when the investor went into the investment, they ran all their numbers, they calculated the return on investment. But that return on investment may seem high on paper, but what you really got to look at once you get into any investment is the return on equity. What that is basically, at any point, you could sell that asset and retrade it for something else. So you always need to be comparing it with the opportunity of going into the next asset. And it's like the opposite, what you're supposed to be doing with your marriage, right? Most people think when they get into marriages, you stay in it forever. But I guess in this case, with return on equity or buying properties, or maybe you might even be comparing it with buying crypto. At any point, you could sell the asset. And the saying goes, at any point you choosing to hold on to the asset, whether that's, again, crypto or rental property, is the moment that you've chosen to buy it. Of course, now you get into all the emotional fallacies that I know that it impacts myself too. Now, what I did with some investors is we go through their property and we relook at their P&L. Likely the insurance probably doubled since they first held it. The rent stagnated, probably went up a little bit if it's been that long. But the question is, would you rebuy this asset today? The use case I use a lot of times is my Birmingham rental properties that I bought back in 2012 to 2015. Back then, those properties were about $80,000 that rented for $900 a month. Fast forward today, those rental properties would be $140,000. Now, do not make the fallacy of saying this is a great rental property because, number one, I've paid down the debt and my basis is $80,000 using that rental property as a case. That is an incorrect way of looking at it. You're looking at a return on investment, but you need to be looking at return on equity. Would I be buying that rental property today at $140,000? Heck no, but I continue to hold it. So essentially, in a way, made my mind to keep buying it. And I have a little worksheet on the website for this, and I'll walk you through this, but you need to figure out, before factoring all the brain damage, the tenants, the maintenance, the annual tax prep, what is it that you are truly cash flowing? And also remember there that you probably have to allocate at least 10 to 15% to capital expenditures. You might have had a property that, you maybe only fixed the air conditioning once, the roof, the appliances, the driveway, the trees with the roof damage. All these things add up to typically about 10 to 15% of your income going to this that may or may not hit you for 10, 15 years for all we know. So add that in too as your real costs. So one of the books that we picked up was, if you read Annie Duke's book, Quit, she talks a lot about reevaluating the situation and making the best decision at the time. She talks about having a kill criteria, or for you stock traders out there, like a stop loss, not just hoping your investment works out forever, but knowing in having game plans saying, if this signal hits, if this person becomes president, which it probably shouldn't, right? If interest rates shoot up to 5% in 1 year, or if people stop staying in Airbnbs, for example, or if the government stops allowing people to do that type of stuff. Again, define that kill criteria. So I asked in this investor, and you may ask this yourself. If you saw this deal on the table today, would you buy it at today's pricing? Second question, are you holding this asset because it's smart or because you're afraid to let it go? Some people mention that they like to have rental properties to teach their kids, give them something to do, menial task of collecting the rent check, or just have it being a physical sign that, hey, we as a family hold assets. I get the whole just behind that, but that may not be the best use for your dollar. Not to give you the early indicator here, but in that case, the return on equity was likely under 2 to 3%, which was like, duh, why don't you just put your money in life insurance and make 4 to 5% pretty much risk-free there? I know I'm not supposed to say that word ever. Saving bonds, life insurance is pretty much the closest thing to that. Real estate syndications, private equity, the complete opposite of that. The third question that you may ask yourself if you're in this situation is, what would your future self thank you for doing if you gave yourself a longer term perspective? As you guys know, I'm all about numbers, right? And the next part of this is building a worksheet framework. Some of you guys will do this into Excel. I have a worksheet to calculate your return on deployable equity on that website, thewealthelevator.com/ROE, to help you run through some of these numbers. But again, what you're doing on this spreadsheet is an equity check. What's your total equity versus annual cash flow? Are you earning less than, say, 4 to 5% on your equity? Now, I'm not saying that you're going to redeploy that into 15, 20%, but certainly if you're making 2 to 3%, I think that there's a much more impact to an investor for getting them up to 5 to 6% on that money than to go to chasing some very risky, high risk, high return deal. Now, what this spreadsheet does is very clearly identifies the then versus now numbers. What you made when you bought it originally, which is your return on investment, ROI, but is that still true today, which is the return on equity? And for all we know, maybe the return on investment is way lower, right? As we all know, holding costs have increased drastically with inflation, taxes, and insurance. The third thing you need to ask yourself is, what is your opportunity cost? Now, you may be a good investor, able to get 15, 20% returns. That's typically what family offices get, who are very well connected and ingrained. That's why people get connected in our ecosystem to meet other people to get better deal flow and become better investors and be able to do better due diligence. Maybe you're just an average investor out there, able to get 6 to 8%. Even if that's the case, then your theoretical move should be to sell that asset where you're only getting 2 to 3% on it. You need to be thinking, what is your friction points here? What's holding you back? Is it the taxes? If it is, have a plan. Is it bonus depreciation? Getting passive losses from other deals? Is it oil and gas? There's actually 6 or 8 different ways you can mitigate taxes on our courses page, which you guys can access. Shoot my team an email, team@thewealthelevator.com, if you're lost in our portal. But everybody who signs up gets free access to that mini course right there. But hopefully that gets you pointed in the right direction so you can have the right educated conversation with your CPA. Another common friction point would just be your fear of giving up control, right? Not a lot of people feel comfortable after owning rental properties for a decade plus of just giving up control or getting away from what's been working. But at the same time, it's like, hey, what got you here isn't going to get you there. And if you're not growing, you're dying. At least that's how I see how many things are in life, especially personal development. If you're not improving, you're going backwards. And although that doesn't quite work the same way in investing, because it's actually really forgiving to be an investor because you typically keep making money. But when you compare it with the pace of inflation these days and real buying power, I would argue that you're probably going backwards. Now, it's hard to show this unless I walk you through the spreadsheet, but think about it like this. I rented a house. It was about a $1.3 million house. I paid the rent. It was like $4,000 a month. So that came out to, let's call it $50,000 a year. Taxes, insurance, something minor breaking. AC on that property is going to be $10,000 right there. So if you think that's the only major repair you had that year, and expenses and property management, that $50,000 quickly shrinks in half. And that's what we call the 50% rule, right? Where half of your income typically goes to expenses. So for those of you guys keeping score at home, let's just say the profits for that rental property for that landlord is $25,000 a year, half of $50,000 of income. So here's the math. You take the profit divided by the deployable equity. This investor had this property owned cash. Like I said, when they bought the property decades ago, they were leveraged and the return on investment was probably in the teens or higher. But right now, the math goes $25,000 divided by $1.3 million is about 1.9%. WTF is what you're probably thinking. That is a horrible return. And when you also include in there that there's other liabilities such as getting sued or other things that could break, right? Basically, that's almost the best you can do. Why would anybody want to hold on to a dirty asset? And I say dirty because it's high liability, right? You typically categorize assets as dirty, safe. Why would anybody want to have a asset like that other than to brag to your friends that you own a rental property when you're making 1.9%, right? It probably would make sense to take that money and just put it maybe in a T-bill or life insurance where you're probably making double that amount without any of the legal liability in there. And that's a very perfect use case. Obviously, in that situation, it is very clear that the landlord just is very used to the status quo, and possibly they are just totally ignorant the fact that they can make a higher yield elsewhere with probably less risk, right? Isn't that what we're all going for? Less risk, more reward. But it's obviously a red flag where you need to make the move. Sell the asset, redeploy the funds into something different. So you've gone and done this worksheet exercise, and this is making somewhat sense. You've got some options, right? You could sell the property outright, which to me is typically the most sense. You could refinance the home or take a HELOC. But for those who've already owned these properties for a while and they've appreciated, getting good debt, especially these days with elevated interest rates, are going to be tricky. The last option is to get a 1031 exchange or a DST. I've done these in the past. They're just not a good long-term strategy as you're going to be in the situation again and again. I've always tried for my portfolio, never giving financial advice here, but the way I see it is I want to diversify my portfolio into as many small chunks as possible. And that's where I like the syndication model to do that. So at the end of the day, it's what's the best option and does it match your current life stage and goals? What floor of the wealth elevator are you at? If you're above $5-10 million net worth, heck, just T-bill and chill, right? Get your, I don't know what they are these days, maybe like 3-4%. But if your net worth is under $2 million, you still have to get after it and you got to get into growth mode and keep getting there. Now, for those of you folks above the $5-10 million mark, I would highly suggest joining our family office Ohana Mastermind. Now, most people in that group are merely trying to optimize their net worth to cruise through retirement and have a great life. It is very rare that we do have some people that want to take it to 8 figures and well beyond. That's great. And that's my philosophy, what I'm trying to do. But we try to keep the ecosystem where people are trying to first optimize for a great retirement first. And if they so choose and investment is their huge passion, that's when they become to morph into a true family office at that point. Hey, let's get all these rental properties making dead weight 1.9% reallocated, get them to T-bills or life insurance making 4 to 5%, and then grow your network, expand your horizons, find better deal flow, and really morph into that family office is what I'm saying here. So this is going to be going out to more of the crypto investors out there, but I think there is some connection with that landlord who holds on to their aging rental properties. But quoting Annie Duke, again, the author who wrote the book Quit, is have a plan for when the world unfolds differently than your thesis. And what that means is write down your assumptions and write down what would cause you to sell and know when a good use of equity would look like today, not 10 years ago. Like we've bought properties when it was tough at the peak of the market, when interest rates were a lot lower and also expenses were a lot lower. And in some cases, it just didn't make sense to hold long term. So we gracefully, as much as we could, went to an exit because things change, right? The assumptions change. And yeah, sure, this didn't happen right away, but this is where reading Annie's book really made a lot of sense going through particular moments. I had real world takeaways from the book, and maybe it will too. Because once you get in it, once you get into that situation where you have sunk costs fallacy syndrome going on in your head, it's going to be really hard to figure out if you need to sell or exit. I guess her book is called Quit for a reason. What this means, if this is not making much sense to you, use a romantic analogy here. Before you go out and marry someone, or even maybe even going dating, write down what the heck you're looking for. Write down your assumptions, define what would cause you to sell, which is define what would be a deal killer for you. Are they a smoker? Are they a schizophrenic? I don't know, write it down. And if you're going through the dating process, or heck, you're married, it's never too late, quit. That's your stop loss when you're investing. If something goes down, if a stock goes down or crypto goes down at a certain point, it violated your holding criteria and you sell. Nothing wrong with that. The only problem is having this sunk cost fallacy where you're just like, just it is what it is. I'm just going to hold till the end. So hopefully you weren't offended by that analogy. I just thought it was a little funny. It is actually very true, right? There are a lot of similarities there. Again, if this episode hit home, I got that worksheet at thewealthelevator.com/ROE. You can right click, download to your Google Drive or download to your computer, or share this episode with another friend who's held on to rental properties, probably longer than 5 years at least, right? People would be in that situation. I'm just thinking out loud here. Maybe the one objection someone may come up with is I'm holding on to this property for the appreciation. But then again, if you look at your ROE and you realize that you could sell that asset, you could probably buy 3 or 4 properties with that money, and you can get 3 or 4 times as much appreciation. So that negates that argument right there. Of course, that brings in more debt and risk, but it makes me super sad that somebody holds on to an asset where they make 1.9% and they're taking on a lot of risks, right? Tenants, termites and toilets, potential litigation, and they could just make it really easy, clean, liquid T-bill and chill. And especially if they're past to a point of $5 to $10 million net worth, they could probably take a lot of that net worth and just live off the cash flow and be totally fine and never really have to worry about anything. That's the closest thing to a guarantee at that point. I'm not saying to go invest it in syndications, etc. out there, but I think that's a big baseline that you work so hard. You made some riskier bets in the beginning. You bought property when you didn't have as much capital and it grew. Great. Now I think the next step is to capitalize on that initial successes and then capstone that into a more sustainable cash flowing investment after that point. But every situation is different, right? If I see you in person over the next few months as we round up the season, let's chat about this. I think every situation is a little bit different. Hopefully, what I would also say is look down your list and figure out which ones are the ones with the worst return on equity percentages, but also have another column and rank those properties, which are the ones with the most annoying tenants and potential litigation, or which one is like you're worried about like the roof falling in or something caving in or some foundation thing happening on it, and use those two criteria to decide every year. I'm not saying to just wholesale out the whole roster of properties, but maybe just prune them off, right? Maybe 10 to 20% of your holdings, churn them out every year. And that may be a more moderate way of taking some action with this discussion today. But with that, see you guys next time. Keep climbing. This is Lane from the Wealth Elevator. Out.